Hey everyone, welcome back to the channel. Today, which Russell 2000 ETF is better for retirement accounts? We have two of the big boys out here this time. The NEOS IWMI versus the Global X RYLD. We're going to break them both down. We're going to look at the yields. We're going to look at the growth. We're going to look at the total returns, of course. And we're going to try to fit which one of these works with tax purposes and how it works in a portfolio like the three bucket system that I totally support. So grab your mug, grab your favorite beverage, pour it in there, sit back. Let's get ready to take a look at the Russell 2000. Hey, before we go any farther, I got to do the important disclaimer, and the content of this is for educational and informational purposes only. It's not financial advice, and past performances don't guarantee future results. Hey guys, if you don't have your mug, and why do I promote mugs? Well, it's real simple. This supports the channel. This gives us the funds, gives us what we need to do to keep putting out videos like this. The cost of this stuff keeps going up. So we just come up with something. We wanted to stay unbiased. So we thought, what else can we do? We don't want advertisers. We don't want to be promoting and all that. So we ended up saying, let's take our logo, put it on a mug, see what happens. You guys have rocked it out. I appreciate it. You've really helped us out. But if you haven't got your mug, we got the 11 ounce, the 15 ounce. They're readily available. Use the QR code, use the link below to help support the channel. So let's take a look at right now, how are we going to calculate these things too? Because yield is a math number. The total return tells us actually everything happening to our money. So we're going to take a look at the cash flow first. How exactly does the fund generate cash? Is it option strategy, sustainable? Really want to take a look at the yield of it as well in that cash flow. This two, we're going to look at the price health. We're going to share the price and the NAV holding up. Is the growth, is it growing over time? Then we're going to take a serious look at that total return, which will answer number one, number two, if they really are working together or are we just faking it out. Then we're going to see where it fits in the structure of portfolio, because we'll look at taxes, we'll look at our retirement packages, what bucket we put into. Everything fits accordingly once we figure out the first three steps of this. So let's identify the funds right off the bat. Global X is a Russell 2000 Covered Call ETF. This one came in April 2019. It has a longer record than our competitor. It's focused on systematic mechanical buy-right structure. And the underlying benchmark is the CBOE Russell 2000 buy-right index. So that makes for a big difference. The expense ratio is 0.60, so about fair on that side. When we look at NEOS, the Russell 2000 High Income ETF, this one came out June of 2024, so a little shorter history. It is an actively managed flexible calls, and it uses the flexible Russell 2000 ETF and stocks. Expense cap 0.68%. Now that's capped until May 1st of 2027, and then it looks like it'll probably end up going to 0.76. So let's talk strategies. First off, Global X uses that systematic approach. It tracks the CBO's Russell 2000 buy-right index using a mechanical implementation. It full overwrite. Okay, it sells call options against essentially 100% of the Russell 2000 equity exposure. So there's a rigid execution. The rule-based strategy provides more predictable but caps the growth potential upside. So that's a huge thing. They're selling an index, which is very common. They're selling that buy-right index. They are going 100% exposure, which is going to cap our top side. So right off the bat, I don't know the answers, but I'm looking at this saying, yep, we're probably going to have a smaller growth package, but maybe potentially bigger income. I'm just guessing at this. When we take a look at the current exposure as of July of 27, they had $1.385 billion of short call exposure. So that was only 0.75 upside before that strike price. So it's a very tight, a lot of money invested into this one. NEOS uses the active managed, uses flex the flexible Russell 2000 ETF exposure, and Russell 2000 calls. So very similar to what NEOS does in a lot of their packages, that they'll build a Russell 2000 in stocks and so on, but they'll always be selling those call options at zero or out of the money type applications. The call spread strategy, they can utilize call spreads to restore additional upside participation and strong rallies. And it's a dynamic adjustment, the capacity to adjust positions before expiration based on market conditions. That's the flexibility of the upside capturing. It's designed to reopen upside potential if the market takes off on them. That's the unique piece with them, that they have that flexibility to do what they need to do. And that's why we call it the Flexible 2000 ETF, is that they're able to change on the dime. So it's one of those things I'm going to tell you. I think you're going to get probably more growth in NEOS than you will Global X. And I think you'll probably get more yield from Global X than you will with NEOS. I could be all wrong. That's why I do this presentation. And honestly, I don't look at these ahead of time. So let's talk about the upside trade-off, the small cap rally scenario. That rigid full overwrite from Global X, that mechanical systematic buy right implementation tracks that fixed income and sells against essentially the full Russell 2000. The significant upside sacrificed during powerful small cap rallies. And like I said, as of June 27th, it was a 0.75 additional upside. I personally like the flexible side of it. I do like that flexible side, that they can do what they need to do when they want to do it. And hopefully the trade-off between these two is more cash today with less upside for tomorrow. That's the trade-off between these two strategies. So if we take a look at distributions, again, Global X, 11.64% as of June 30th. SEC 0.61. I'll explain that in a second. And then the forwarding analyzed fund about 12.4. We go to Russell, 13.84 for the trailing 12 months, 0.50 SEC yield, and then 14.42% annualized rate over time. So the whole switch of income is leaning towards Russell. So let me explain the SEC yield first off. SEC yield is your distributions plus any interest. Okay, so what you always want to do is take your SEC yield, deduct it from your trailing 12 months to take a look at how much of the covered calls have to generate. So in this program with Global X, you're basically looking at 11% that the fund has to generate from the call options, because they're putting everything to work. They have a little bit of money on the sidelines of interest, some dividends accordingly. Russell has to work a little bit harder because they only have a 0.50% of dividends and interest. So when we run through these numbers, now why do you ask what's the difference between the fully analyzed and the trailing 12 months? What they do with the forward analyzing is they'll take what the last distribution was, divide it by the NAV, and then calculate out what it is over a 12-month period. So what you want to see is you want to see your forwarding analyzed number higher than your current one. That means it's growing. The distributions have a chance to growing and getting bigger. Or, and the other side is you'll start asking yourself if the fund price is actually going down. So these are numbers that you want to look at and say, whoa, what's going on, to give you an answer. Hopefully it's always on the positive that the distributions are coming up. But overall, the structure that they're doing, giving NEOS definitely some better income. Hey guys, don't forget about our 40-ounce mug. That one has been selling off the shelf real quick. We still have some inventory left on the shelf right now before we get our 4th and 5th loads in from those. Just want to throw them out there. Don't forget about our 40-ounce travel mugs. Fit great in the car. Now, 1 year share price growth. This is the health check that we want to look at. As we look here, the growth of the two funds, NEOS is knocking it out of the park. Okay? IWMI outperformed RYLD by 10.6% in share price growth alone, While distributions provide cash, the price stability ensures that the payments aren't just returning your own money as ROC or capital and eroding the program. So the IRL shares from June 30th of 2025 to June 30th of 2026, a good solid 1-year package, the shares are up 12.8%. So this is not total return. This is just pure growth. Now you add in what the distributions are, now you're seeing some serious total returns. Global X 7.2 versus NEOS 17.8%. Major difference between the two when we're looking at this total side. When we look at total return, this is the number I use all the time. This is the first place I go to. Why? This tells you what's actually happening in your fund. Now, these numbers will always have that when you drip or pour your dividends back in as the way they calculate it, you're going to get some serious numbers. NEOS comes in at 29.39%. That means if you put $100,000 into this fund, okay, you're at the end of the year with dividends, with growth, with everything added together, you're going to have 29.39% gain in your package. Global X, 21.90%. So we got about a 7% difference between these two. Where is it coming from? Well, it's coming from both sides. It's coming from the yield and it's coming from the growth side of NEOS's flexible program versus the 100% fixed right program. That's where I always say the capped product of Global X is hurting the fund by the growth. So these are the big factors between the two. So win for NEOS on income, win for growth, and now win for total returns. Now, RYLD's longer track record, the value of history, we take a look at this. Operating history is a vital asset for retirees. It provides a fuller view of funds behavior across multiple market environments. Rather than a single snapshot in time, the results will not have any guarantee of future success, but a long track record helps evaluate, have they done this over and over again, or is it just all of a sudden a shot in the arm that small caps took off today, but in the past 5 years they haven't. So we take a look at RYLDs, a little more information, like I said, we got, we can look at since inception, we can look at the 5-year mark now, we can look at the 3-year mark now, and you can see a lot of this comes into play. That over the past 5 years, their average was 2.78 annualized return. We look at 3 years, it's on an average of 8.28%. Since inception, 5.71. So we're seeing the last 3 years that the small caps have definitely rised accordingly. So it tells me that we're in the market with the small caps doing a very good job so far and growing. Now, the return of capital. This is a big question that people ask. This is actually what your tax side comes into play. Both of them use ROC. Now, that's what I'm going to stop right there so everyone can understand. Global X uses ROC as their primary tax program. So in 2025, they classified 83.3% of their distributions at ROC. So that means $1.52 out of $1.83 was ROC. They're estimating right now June 26 distributions was 100% estimated. Now, NEOS on the other side still is declared 81% ROC, but they also use the 1256 contracts. They also use tax loss harvesting. Okay. Now, what are those? 1256 contracts comes out and says, look, because we did it into the select index in a certain way, we've gotten the 1256 contracts, which are 60% long-term capital gain, 40% short-term capital gain. That's the first bite into the tax biscuit. As of if they're putting it as long-term capital gain, you can have a 0%, a 10%, 15%, somewhere in there, tax burden on those distributions. Now, they'll also turn around and do tax harvesting, which is they'll take a particular fund that's losing money, they'll sell it off. Now, they have to wait about 30 days before, if they wanted to add it back into their package, kind of a rule the government has to it. But they take a look at what's losing, what they've lost on, sell it, and use it for tax harvesting, and then come in at ROC. So it's not as simple as, wow, 83 versus 81, give it to Global X. NEOS does a better job across the board. What I put it to, though, is this. If you're watching these high ROCs, you need to pay attention to the growth, your NAV, and your actually assets under management. So if you want to make sure that this is true ROC just for tax purposes and not NAV erosion or a NAV of adjustment to any side of the coin. So when we get into the tax account and tax treatment onto this, in taxable accounts, IWMI actually is the better piece of the puzzle. It has a slight edge because of the 1256 and the tax harvesting. In IRA, I think both of these two are essentially, they're tied. They can do the same exact thing across the board because in a tax program, IRA, Roth, 401k, they have to follow the rules of the fund and the rules that are set for those particular pieces. So really about a tie. But if you're in a brokerage account, which most retirees will be because it's easier to deal with than dealing with Roth, you have more options and so on. So the little edge goes to IWMI with the NEOS program, which we find a lot of that with the NEOS package. So let's take a look at the head-to-head comparison, the scoreboard that we use. So the winner in distribution rate all the way goes through NEOS, 13.59% trailing. The share price growth, boy, I'll tell you what, NEOS nailed this one, 17.8 to 17.2, win NEOS. 1 year total return, NEOS. Expense ratios, guys, I gotta be nice and give it to Global X. That 0.60 to 0.68, that is just how long it's gonna cost you to hold it for long periods of time. Operating history, gotta give it to Global X since 2019. They got 7 years under their belt already on this one. Taxable, as I said, these are two, I'm going to call them a tie. I'm going to put a little lean into NEOS strictly because of that tax harvesting side of things. And really have to say the 1256 contracts. But the tax advantage in a standard account, it's a trade-off. It's equal to each other. So overall, guys, I think IWMI leads the performance metrics across the board. So let's talk a little bit about the risk for retirees or risk for anybody who's investing in these. And it still needs to be respected. The small cap and the equity volatility. Sharp declines in the Russell 2000 has exposure to experience significant and sudden price volatility. This is not a shield. Okay, this doesn't eliminate the underlying equity losses. And the upside trade-offs, the strategies can sacrifice upside in major rallies while retaining full downside exposure. And I really got to cover both of those, but Global X really falls under that one for sure. Now, the sequence of returns risks, the recovery hazard is spending income during market decline can make principal recovery mathematically harder. That's basically saying if you're going to spend your dividends like I would because I'm retired and living off of dividends, you're not putting money back into it, so you better have something growing your funds to be able to cover. Variable payouts, you don't know what you're getting month in, month out. You can't sit down and say, I'm getting 20 cents, 50 cents, dollar, whatever from a fund because this thing bounces around because it's majority being used by the covered call strategies. And there's no capital protection. Neither fund guarantees principal preservation or simplified specific total returns. So these are pretty much, I don't care what investment you make into, a lot of these risks are going to be the same exact thing that we're dealing with. So my final verdict, IWMI still wins across the board with the Russell 2000. I really think IWMI, because of the higher income generation, the superior price, the help that it's getting from its growth side of it, the total return lead that it's dominating that market, and the tax efficiencies across the board. I really don't think you can beat that as a package. Now, the case for RYLD, the long-term operating history definitely has some value to it. And the cost advantage, the lower expense ratio, if you're going to hold for long periods of time, that little edge, I got to give you something to over there. But the predictability is the systematic mechanical index tracking, the buy right implementation, probably an easier one to understand, to follow, and to flow with it. But I just think even with the shorter time frame, I still got to lean towards IWMI as being the total package when it comes to the Russell 2000s. Now I put these in my income buckets. I use the IWMI as my core. I'm not being prejudiced about this. I'm being wide open to it. I'm always watching and testing these things. But where I personally own IWMI, it's in my bucket, liking that extra income coming across the board. So guys, what it tells me, IWMI is going to be a tough one to beat as we go through these comparisons. So let me know what your thoughts are in the comments down below. Do you think IWMI? Do you currently own it? Do you think it's the better option? Or do you own YLD? I'd love to hear from you. Leave a comment down below. Hit the like button. Helps the channel the most. I love to hear where you guys are at and if you like what we're doing. I'll catch you on the next video.